shape. Stress test just went on, and our losses were lower than they were last year, and we've been the lowest of our peers for almost every year except for one have the last 12 or 13 stress tests. So you put that all together, we're well prepared for whatever comes at us, and that's what we do. Jimmy and the team have done a great job in trading, but about 3 or 4 years ago, first under Tom Montag, and then Jimmy took over all the trading, we increased the size of the balance sheet, the scope, the capital committed to business, the talent, and they've been able to get a good payback on that. And the way they do it is, we made money every trading day. If you look back across the last several years, it's very rare, maybe a couple times a quarter we'll lose money. We just basically, the team runs a great business, and they're doing a great job.
The markets woke up yesterday to the announcement of the Fitch downgrade in U.S. sovereign debt, and there's a debate about whether that was the right timing, was it the right thing, and the bond market now is actually responding a little bit to that. What's your take on that derating?
Well, I think it's a bit of a non-event in the sense that the U.S. has the ability to pay its debts and has shown that ability. It's sometimes interesting how we get there with the debt ceiling increase and things like that, but they get there. It's the strongest economy in the world by a lot. It's the biggest economy, the strongest economy. It's where capital comes to from around the world. Great incentives in the U.S. for companies around the world to invest and grow here. The IRA, the Infrastructure Act, the CHIPS Act, et cetera, et cetera. The tax rates are lower, which makes it more competitive. So I don't worry about the fundamental ability to pay our debts. But if you separate the downgrade into two pieces, one is sort of the debts that continue to accumulate, and will they start to outstrip the growth in the economy? Because right now with inflation they've been kept at a lower level. That's a question. And then secondly, is there a willingness to deal with that? And that's an honest debate, but the two sides have to have that debate, and that's a political process, and they have to have it. But the reality is the actual downgrade, as a person holds $300 billion more treasuries, it doesn't change our opinion of the U.S.'s creditworthiness.
Well, what about that holding the U.S. treasuries? Because as you suggest, there is an issue at some point down the road. It's not clear when it would be. And when you talk about the process, the political process, it doesn't give a lot of comfort. That's one of the things that Fitch said, actually. Is, we got a problem, but also we got a process that doesn't seem to be able to deal with it.
Yeah, and I think that goes back to the structural changes in America, the demographics, the demands on Social Security, and the so-called entitlements over time as a percentage demands. Those are serious issues that the political process and the citizenry has to be involved in. Not solvable in 10 minutes, and so that's all good. And that's what we're talking about here at the Aspen Economic Strategies Group. What are the thought processes between balancing those outcomes better? But those are long-term questions. In the near term, there's a much bigger risk of some of the things that go on outside the United States to the economies of the world than there is inside the United States. We're growing, people are employed, people are spending, and that's good news. And that will mean that the fiscal receipts of the U.S. will stay a little stronger on a relative basis.
How much is it supported simply by the strength of the U.S. dollar? That is to say, people tend to turn to dollars when in doubt.
They should, because it's it's a safe haven. It's what commerce is conducted in, because in the end of the day, the consumption power of the United States drives economies around the world. Therefore, there's U.S. consumers spend dollars, so if you're selling stuff in dollars, you got to be exposed to dollar. And so I think the idea of some of this debate about reserve currency status, it's been tightening, and the flight to quality in the U.S. tends to come. Now, 10-year bonds moved up, and everybody gets wound up. But we're talking about the difference between 380, 390, and 410, 420. Mm-hmm. These are not very big moves in the grand scheme of things. It is happened quickly, and people get excited about it, who trade bonds as living. From the grander impact in the economy, those moves are needed to get ultimately the yield curve has to get back in sync, or else we aren't taming the inflation, or we're going to drive into a recession.
When you talk about the strength of the U.S. dollar, is it stronger today as a reserve currency globally than it was 10, 20 years ago? And if so, why?
Because I think the opportunities in the U.S. are the strongest, and that's why, with a great financial system we have, with a great set of companies and innovation we have, the research universities we have, the things like, if we keep investing in all that and let capitalism and, United States style capitalism drive, the U.S. will always be a favored place, because other places are struggling with different systems that prove not to be as beneficial, with less innovation, less ability to tackle problems. And so yes, it's interesting from time to time all what goes on. But if you think about the late 60s to now, we've doubled the amount of people working in the United States. We were supposed to be taken over by Japan Inc. The computers were going to get rid of all the people. The people are still working. We had the war in Vietnam. We had the political constitutional crisis in Nixon presidency. You had an oil embargo. All that stuff happened in the early 70s, and still a decade, 50 years later, we have twice as many people work in this country.
Since we talked last, Brian, we now have the proposed regulations on capital requirements from the federal bank regulators. We talked before, and you said 100 basis points, as I recall, a difference in the capital requirements would amount to $150 billion less your loan. Now we have the proposals. What would it mean for Bank of America and for our banking system?
Well, what it does is it's not to get too technical in the grand scheme of things, but it changes the calculation of risk-weighted assets, RWA. And so the idea is that the estimates by the Fed is it's 15 to 20% of RWA increase. When you do that, then 10% of RWA at X and 10% of RWA at 1.1 times X means you have to have more capital. And so the amount of capital goes up. That then constrains lending because you can't do anything with that capital. If you did, then you'd have more RWA and you have to have more capital. But I think if you step back, this industry is well capitalized. It just proved it again in another crisis. It's well managed. It's well regulated. You've had successive Fed regime, chairs and people working in the supervision vice chair over the years say the capital is adequate in the industry. It's well managed. It's well capitalized. Banks will fail. They failed throughout history. That happens. But since the financial crisis, more people under the tent because the issue of the financial crisis, a lot of stuff wasn't a tent. The problem is if you get the capital regulations of the banking system too tight, you push stuff back outside the tent, and that's a concern. So as I look at it, one, give a set of rules, we'll live with it. Two, it won't, Bank of America will adjust its business model to make it work. But what's been interesting about this is its competitive position in the United States versus Europe and others. This is making the bank industry, all banks, less competitive to mid-sized U.S. companies than foreign banks are to mid-sized U.S. companies participating in the same global supply chains in those countries. That's more of a trade question and a balance of power question. That's one. And then second, I'm surprised by the amount of dissent at the governors of the Federal Reserve. I've been working on Federal Reserve stuff for my whole career, 40 years now, and I was just surprised at the amount of debate, which shows you that, whether it's mortgage loans on one side, whether it's tax benefits or and treatment for clean energy investments, or whether it's the basic trading and things like that. There's a lot of water that's got to go over the dam here to get these rules right, because there's a debate even among the governors themselves about what the right answer is.
Over the years, Brian, you said there's a role for regulation, and you'll live with regulation, as you say you will with capital requirements. But what is the problem that's being addressed? That's what I don't quite understand. You talked about the crisis we had back in March with the banks. I'm not sure this addresses that.
Well, and that's been the debate, and that's go read the dissents and the debate in the thing. So strong regulation is important. Rapid growth in banks tends to come from things that turn out to be not so interesting after the fact, and so I think that's the thing. They need to sort of come to a common agreement on Basel III across the world. We're just applying it with much more rigidity and requirements. And so if you look at the largest bank in France, UK, and Germany, they have about half the capital requirements that the largest banks in the U.S. do. So that gets into competitive question. And so I think people just have to look at it seriously, look at it relative to what we're trying to do here. We want the strongest banking industry. Our banking industry has better returns, has better things. But on the other hand, our multiples are half or less than the S&P multiples. There's a reason for that, which is investors are saying, wait a second, if the capital demands don't stop, we aren't sure that we can continue to invest. So there's a little bit of a countervail here that people have to pay attention to. And then back to your point, every 100 basis points of capital is 100 billion less loans we at Bank of America could do. And this applies across, they can't be done other places. Those companies aren't that sizable.
Yeah. Brian, thank you so much for spending time with us. Really appreciate it. That's Brian Moynihan. He is the chair and CEO of Bank of America. Guy, back to you.
David, fantastic interview. So much to discuss. Really interesting to hear what Brian had to say. As David says, that of course was the CEO of Bank of America, Brian Moynihan, speaking to David Weston, our Wall Street Week host. You can see more of David's interviews, and there are many still to come from the Aspen Economic Strategy Group. We've got them all coming up, 6 p.m. New York time, Wall Street Week. Looking forward to that. Look at those names, fantastic names. This is Bloomberg.
Authority.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, once again, it seems like a day that's all about the bond market.
It is about the bond market, but I would argue that it's also about some of the risk assets such as stocks, because we have the S&P 500 and the NASDAQ 100 down solidly. The S&P 500 down for 3 days in a row. Same deal for the NASDAQ 100. Bonds, to your point, though, selling off. That 10-year yield well above 4%, up 10 basis points. And then the VIX, relating it back to stocks volatility. We don't really need the VIX to know this, but volatility is on the rise at a 17 handle. I would argue, though, that the other big piece of the market story, not just today, but this week, it has to do with the Bloomberg Dollar Index, buoyed by rising yields, up 1.2%, the biggest four-day winning streak for the dollar going back to early February. That, of course, when risk assets are denominated in dollars and the dollar's going higher, brings down the value. We're seeing that in a very basic level. As for the micro, though, it's not so pretty there either. Qualcomm down almost 11% on a disappointing quarter for guide for this quarter. Weak iPhone or cell phone, I should say, demand. PayPal down even more, down 12%. The transactional operating margin not great, not what folks wanted. A little bit of a miss there on a sequential basis. And then playing it forward, Amazon down 0.6%. Apple down 0.8%. Apple stood out to me for a while because one of the problems with all these big tech companies for the quarter that we came into, revenue growth just not that great, basically single-digit growth. Meta defied that. Apple is actually expected to decline. Let's take a look at an updated chart of Apple that we've been looking at over the last couple of weeks, suggesting that we could really see Apple put in a serious decline. This convergence of buying tells you the buyers are getting tired, that the sellers are ready to pounce. Well, the sellers are already starting to pounce as this uptrend breaks. We're about 20%, or excuse me, 15% above the 200-day moving average. You can see, Guy, that we did something similar back here, a similar convergence, and then down, and also the RSI, which has recently just come out of overbought territory, suggests that we could just see some more froth come out of Apple, and as the biggest weighting to the S&P 500, maybe the markets overall.
Yeah, I think if Apple goes down significantly, then I think we can probably expect a wider market sell-off to follow that. Abigail, great stuff. We'll certainly be watching out for that one. Amazon out with numbers. Apple out with numbers a little bit later on. We'll walk you through what we're expecting a little later on the show. Let's talk about what's happening with the employment story. We had a whole range of data out today telling us a little bit about what is happening with the labour story stateside. This as we count you, of course, towards the payroll number that is going to be out tomorrow. That's the claims number. Sorry, we need to talk about the claims number. That's the expectation in terms of what we're going to get tomorrow. The estimate 200K. 209. These are still relatively elevated numbers, but in terms of claims, they tick up a little bit today. The ISM services employment number ticks down. The number that stood out to me today actually was the productivity number, which ticked higher, sharply higher today, which is quite significant. The real question is, to my mind, is are we in a position where we need to see, if we do see rates going higher, does that ultimately end up breaking the labour market? It kind of goes back to our question of the day, which is what breaks if rates keep rising, and maybe the labour market could be one of those elements. Let's get some sense of what is happening here. Corey Katanga, senior economist at LinkedIn, joining us now. Corey, we're marching towards the payroll number tomorrow. We're watching what is happening with a rising rate environment. Yields are up pretty sharply. Talk to me about how you think, what the relationship at the moment is between rising rates and the labour market. Is the Fed ultimately, with higher rates, going to break the labour market? Does it need to break the labour market?
Well, we certainly hope the Fed does not break the labor market. There's no reason to think that they would necessarily need to break the labor market. Right now, the labor market still has shown some solid growth, right? Employment growth has been above trend. The current consensus expectation is for employment growth to be on trend. Here at LinkedIn, based on what we've been seeing in our data and external data, we're actually expecting employment growth to potentially come in a little bit above trend, probably in that 250 to 270 range instead of that on trend 200,000 range. So we've seen a lot of resilience in the labor market, but we've also seen a lot of air being let out of the labor market. At LinkedIn and the LinkedIn hiring rate, where we track how hiring is changing from month to month, we've seen hiring come down about 3% from June to July. So there is a lot of air that's already been let out of the labor market, and we're starting to see the labor market kind of moderate a little bit. So we're still seeing hiring decline, but that decline has moderated in sort of the lowest year-over-year decline in LinkedIn hiring data. And we're also seeing quits start to decline, right? And that's part of the reason why we're expecting that payrolls number might come in above consensus. Just we're not seeing as many people quit as we did a few months ago.
Are we seeing as many companies laying people off as we talk about maybe the fact that hiring is slowing? It also is a question of the pace of firing when it comes to unemployment.
Right. So we got a good read on layoffs on Tuesday with the job openings and labor turnover survey. And layoffs are still steady. The layoff rate has not changed. It's been steady for quite some time. And layoffs are still at record low numbers. We do see there are some pockets where, layoffs are particularly prominent, and that's kind of a lot of what we're seeing in the news. But layoffs are still pretty well contained and fairly low. So really, when we say, okay, there's a lot, is there going to be a rise in employment? We're really going to need to start to see that layoff number tick up if we're going to start seeing a rise in unemployment. Even from this morning's unemployment insurance claim release data, there wasn't really a significant change there. We've seen unemployment claims be pretty steady so far this year. So unless we start to see unemployment claims rising fairly sharply, we're expecting that layoff number to kind of remain fairly steady, even though hiring has declined.
Okay, Corey, if the picture you're painting is a fairly positive one, is that picture you're painting consistent with 2% inflation that is stable?
Right. So one of the big concerns that folks have is that the labor market is still very robust, maybe a little too robust, right? Because there are kind of two things that are going to be feeding into inflation. One is what the Fed does, right? Can they slow demand down enough in order to let supply catch up? Another thing is kind of what consumers are doing, and a part of that depends very heavily on the labor market. So consumer spending has been quite resilient, and that's what's been one of the driving forces of why we keep seeing rate hikes, right? Consumer spending has been resilient, demand has been resilient. The only control that the Fed has is to bring down demand. So in some sense, they do need to decrease demand, decrease consumer spending. And if there's a very strong labor market, right, consumer spending can continue. What we've seen, though, looking forward, is that consumers have run down a lot of those excess savings that was driving a lot of spending, right? So in that sense, the Fed may start to reach a point where it makes sense to really take off the brakes, right? Because what may be driving consumer spending at this point is kind of having a strong labor market. And as I said earlier, we've seen a lot of air let out of the labor market already. So if we continue to see a softer labor market, right, and we're definitely going to see consumer spending start to show some softness eventually. And just remember, things can change.
Well, and Corey,
yeah,
obviously the spending patterns in theory also would be impacted by wage growth relative to inflation. So what are you seeing on the wage side? How much pressure is there still?
Right. So on the wage side, we're seeing wages that the expectation is that they're still a bit above what they need to be consistent with 2% annual inflation, right? And we actually saw ADP numbers yesterday, and again they showed wage growth still pretty strong, but it has been coming down. If you look over the last 6 months, nominal wage growth, particularly real wage growth, they have been slowing down, right? So what we're seeing is sort of this gradual slowdown in wage increases. We're also seeing this gradual slowdown in hiring. So, there's no sense right now that the labor market's going to break and that wages are going to be a big part of that. But we are sort of just seeing the air being let out, right? And we're going to need to see potentially wages come down a little bit if it actually is the case that wages are part of what's driving inflation.
Okay, so
All
let's
right,
figure
Corey.
out where we go next. Sorry, Corey. Kaylee?
I think, unfortunately, we are out of time, though we would love to continue this conversation. Corey, thank you so much for joining us. Have a happy Jobs Day tomorrow. Corey Katanga of LinkedIn. Now, coming up, we're going to turn to banking. One of Citi's top bankers, who runs one of the biggest trading houses in the world, is leaving the bank. We'll have more on Paco Ibarra's exit from Citi and what it means for Jamie Fraser's strategy coming up next. This is Bloomberg. It's time now for Wall Street Beat, where we look at what is buzzing on Wall Street in the world of banking and finance. And today, we're looking at the announcement that Paco Ibarra of Citi is leaving the bank in the first half of 2024. Joining us now is Bloomberg's Sonali Basak. Sonali actually just spoke with him last week right here on Bloomberg TV. So I guess a lot can change in a week, Sonali. How significant is this move?
Yeah, it's like the world changing over at Citigroup in just a week. Remember, Paco Ibarra was one of the most trusted lieutenants when you come to the strategy changes over at Citigroup under Jane Fraser. So what did he do? He led all of the institutional businesses. That includes one of the largest trading houses on Wall Street, certainly a giant in the space of fixed income, rates, currencies, and commodities as well, but really rates, currencies across the globe, with Citigroup being the most global bank really in the United States. But also he ran and oversaw here the security services business. This is the business that really deals with payments across the globe for many corporations, fintech companies and other banks. And remember, this is really one of the fastest growing parts of Citigroup that they are really trying to get investors to focus on. So this is what Paco just about a week ago had to say to me.
And are getting more challenging. They're getting more challenging in England and parts of Europe. They're going to get more challenging in certain industries in the U.S. And that is how we think about the world in 24 and 25. So, you know, along with the evolution of how capital gets provided, certainly the higher cost of capital and tougher financial conditions are what we would expect as a base case.
That was indeed not Paco Ibarra. That was Jim Zelter, the co-president of Citigroup, of Apollo Global Management. But that does bring us to our next story, which is Apollo. Remember, the movement out of the banks have gone to the non-banks, like Apollo. Apollo shares, guys, hitting a record high today off the heels of their earnings.
So what's the takeaway from Apollo? They're leaning obviously on certain key divisions. This is a business that wants to transform the way that investors, the way that Wall Street, the way that the world perceives it. To what extent are today's numbers a demonstration of that kind of new perception, that new kind of idea of what Apollo is, Sonali?
You and I have been talking about this all week, Guy, this shift away from this trend to this conception of private equity into private credit and other things, the new meaning of an alternatives firm. The amazing thing about Apollo is it's not just about private credit. They had merged a while back with Athene, which is an insurance company, not even really an insurance company, an annuities company. This is a spread business, and they are just firing on all cylinders. They are giving investors to something to bite onto. All together, you have second quarter adjusted net income surpassing $1 billion over at Apollo. A lot of that was helped by that Athene business that earlier investors had a hard time wrapping their heads around. But it's showing you that this kind of permanent capital business as well as a spread business can work well, particularly in this higher interest rate environment. And really, when you look at Apollo Athene, this is the biggest kind of private equity insurance play on Wall Street, and so many people have followed. Blackstone has their own strategy. KKR has doubled down. Brookfield is buying an insurance company. And so you're seeing this play start to pay off.
Sorry for the wrong sound, Sonali. Nice save, though. Great to see you as ever. It's been a busy week. Sonali Basak, thank you very much indeed. What are we, 46 minutes past the hour? 46 minutes past 7 on the West Coast. So let's get to the startup. It is going to be a busy few hours in the Bay Area and beyond. Silicon Valley starting its day. How is that day going to finish? It looks a little overcast at the moment. What kind of visibility are we going to get by the end of the session? Because Amazon and Apple are about to report numbers. Ed Ludlow is on tenterhooks. Ed, what are you looking for?
Yeah, you know, the thing that connects Amazon and Apple broadly is a tough macro environment, right? Both have large exposures to the consumer. You know, I think that we have a high bar earnings season. You know, look at the performance of the two names year to date. Apple 46%, Amazon 56%, something like that. I think it takes something pretty spectacular to continue to move the needle higher. And you look at the Bloomberg consensus, you know, for Apple, we're expecting the third consecutive year-on-year decline in sales, only services set to grow. 3 straight quarters of year-on-year declines is the longest stretch of sales decreases for Apple going back to 2016. It gives you a sense of the reality of where we're at.
Well, and for Amazon, I wonder how much this is really going to be in a quarter exclusively about AWS, given what we saw with Microsoft and the slowdown in its cloud business.
No, I love covering Amazon for that reason. AWS is the cash cow. You know, as soon as the earnings print hits, look for AWS. The concern is that you can use its peers to kind of think about what's going to happen. Last week, Microsoft showed slowing growth in cloud. Microsoft's Azure is the leading competitor to AWS that dominates the market. Are they going to go through the same thing? AWS has in past quarters been the bright spot. It's just much higher margin revenue. You know, at a time where Andy Jassy comes in for Jeff Bezos, has a year in the job and says, I need to look at some of these other businesses and rein them in a bit.
Ed, just as an aside, there has been this perception that the technology industry is now dominated by AI and therefore is less rate sensitive. Yeah. Are we starting to see maybe that theory being tested a little bit here? How much more can it be tested?
You know, like, think about those that have reported already, Alphabet, Microsoft, and Meta. It was their core legacy businesses that the market traded on. You know, in Alphabet and Meta's case, advertising. So that could be a bright spot for Amazon. Apple has shown complete restraint in talking about AI, but Mark Gurman, of course, ahead of the curve, has reported they are working on a generative AI tool internally. But just based on the precedent of the last 2 weeks, the market is listening to the AI hype on the call, but then trading based on the performance of the legacy businesses. So with Apple, it's iPhone, right? The context for AI on Amazon is they went a different direction. They lean into AWS and say, what can we sell to our existing cloud customers? What tools can we offer through Bedrock so they can take advantage of our own large language models through Bedrock or third parties we already partner with, and basically have a ready-to-go enterprise-focused offering. That question next is, are they making any money off it, or when will they make money? So it's another thing to look for in the call.
All right, well, looking forward to your coverage of it all throughout the day and, of course, after the bell. Bloomberg's Ed Ludlow, thank you very much. And you can catch Ed on Bloomberg Technology in around 90 minutes' time. Coming up first, though, Alex Steele is on location in Oklahoma City. We have video there of her trying on cowboy hats. Oklahoma, of course, is known for its cowboy culture, but it's also home to major U.S. energy companies, and Alex is there for a big interview. We'll have more on that next. Great hat. This is Bloomberg. Stocks are down, yields are up. That basically is the story of the day today. Right now with S&P 500 down by about 0.5%, but the massive moves are in the bond market. The 10-year Treasury yield up 11 basis points at 4.18. This is the highest level we have seen since November as that selling pressure really builds in the bond market. Where we are not seeing selling pressure today, though, interestingly, is in energy and oil. Crude, New York crude, WTI up by about 1.4%. We're back above $80 a barrel after the Saudis said they're going to extend their voluntary cut of 1 million barrels a day through September, and that cut could be extended and deepened. So that is lifting oil and lifting energy by extension today. The S&P 500 Energy Index, an outperformer today, up about 1%.
So Kaylee's been kind enough to join us today because Alex is on assignment in Oklahoma City. She's got a big interview coming up. She joins us now. Show me the hat.
Here it is. Here's the hat, guy. This is for you. I'm messing up my hair just for you. You like it? I think it looks good.
That's great. But you didn't buy the boots.
I didn't buy the boots. The boots were amazing, but I did buy the hat.
So
it was a lot of fun. We came in last night. It was like 100 degrees.
Alex has this whole thing that hats don't look good on her. I think that looks good on her.
I would agree, Guy.
But we were joking that like the one hat that would look good would be a cowboy hat, which would be pretty funny to wear around New York City. But I am here. I'm in Oklahoma City. I'm physically here in the Ham Institute. It's basically a place where you can go and explore new technology and ways of getting oil out of the ground, and also an education center. And I am here to interview Harold Ham, a legend in the oil industry. He launched a book, A Game Changer, and in it, it truly is like a plea to the oil industry and to politicians and to America to unleash more oil and natural gas and don't make them the enemy, which is so interesting when we're looking at a world where the Saudis are in essence trying to prop up oil around $80 a barrel.
Okay, well, you mentioned the politicians, Alex. I'm here in Washington where you don't often see cowboy hats. You just see a lot of like American flag pins on people's suits. But how are you going to talk to Mr. Ham about politics? Because obviously he has a voice there.
Oh, he has an enormous voice. He was actually very instrumental in the Obama administration in getting the U.S. to actually export oil. He's a huge voice. He was an early supporter of former President Trump. He is not supporting him this time. So definitely going to be asking who in the candidate world do you actually like and support. He also is extremely critical of energy policies under President Carter, and then a little critical also about President Biden. So sort of what he's so worried about when you are seeing oil production here in the U.S. near pre-COVID levels, when you are still seeing growth in the U.S., when you are seeing inflation come down, when things look okay, what is he so afraid of? We're going to get into that a little bit. And who he supports, because he can really help bring the industry along with him, is going to be very key, I think, for the Republican candidate.
I can't believe you've done the whole hit with the hat on, which I think is amazing. The hat probably isn't going to come off until... But look, Harold's on the front page of his book, the cover of his book, wearing a hard hat. So maybe he does it in the hard hat and you do it in the cowboy hat, and that would be an amazing interview, I think. I think this is the way to go.
We'll think about it. We'll think about it. Okay. This is the way forward. This is the future, Guy.
Honestly, the hat looks good. The hat looks good.
It looks so good.
There you go. Right, well that's what's coming up in the next hour. We've got all kinds of things coming up, but the main one is that we've now seen Alex in a hat. Whether we see her again in a hat remains to be seen, but that conversation with Harold Ham is coming up. Continental Resources Chairman, it's coming up in the next hour. We've got the European close coming up as well. The Bank of England today raising rates by 25 basis points. Is the Bank of England nearly done, I think is a key question. Deanne Julius is going to be joining us as well to give us her take on what is happening here. We've certainly seen quite a big reaction in the markets today. The front end of the yield curve, maybe not where the action is today. It's all in the 30 on both sides of the Atlantic. Anyway, the European close is coming up next. This is Bloomberg.